Most new traders log into their accounts with a single overriding goal: figure out exactly what the market is going to do next and outsmart it. But the reality is far less forgiving. The market is a massive, chaotic engine driven by millions of competing participants. It does exactly what it wants, completely indifferent to you, your positions, or your bank account. Think of trading like driving a car. The price charts you analyze are the road in front of you. Your trading strategy, your moving averages, support lines, and setups, that is the steering wheel. But there is a missing piece to that equation. The trader's psychology is the driver. You can have a perfectly paved road and a top-of-the-line steering wheel, but if the driver is panicked, a crash is inevitable. Since you cannot control the road, the only variable you can actually master is your own mind. Inside that driver's seat, logic is constantly under attack by two specific biological responses: fear and greed. Fear is the equivalent of slamming on the brakes for absolutely no reason. You see a tiny dip in a profitable trade and panic, closing it out far too early. Or worse, you watch a losing trade approach your exit point, and terrified of taking the hit, you keep moving your stop loss further down, hoping it turns around. Greed, on the other hand, is mashing the accelerator without looking at the road. It looks like taking 10 random trades in a single hour, impulsively doubling your position size to chase a quick win, or stubbornly holding on to a massive profit because you want just a little bit more. This diagram shows how those core emotions fracture your discipline. From a central hub, greed branches into overconfidence, leading to bad entries and excessive risk. Meanwhile, fear spirals into desperation, causing you to take random trades just to feel active. While fear makes you freeze and greed makes you sprint, the destination is identical. Both behaviors bypass your trading system entirely, steadily draining your capital until the account hits zero. The market operates as a highly efficient machine designed to exploit these exact psychological flaws, trapping untrained participants on a predictable emotional roller coaster. This chart illustrates a typical market cycle. Prices climb to a green peak of pure euphoria, where traders abandon risk rules. Then the trend breaks, dropping rapidly through anxiety and panic, until hitting capitulation at the bottom, selling at maximum financial loss. This cycle repeats endlessly, quietly transferring wealth away from individuals riding the emotional waves, and hands it directly to those executing rigid, systematic plans. To stop being a passenger, you must adopt the mindset of a pilot. When a pilot flies into severe turbulence, they do not scream, they do not get angry at the clouds, and they certainly do not start pressing random buttons to gamble their way out of it. They trust their instruments, and they execute their pre-flight checklist. This flowchart divides the trading day into 3 strict phases to separate emotion from execution. Notice the bookends. Pre-market preparation sets the foundation, and post-market evaluation analyzes performance. The actual trading only happens safely within those boundaries. True emotional control does not mean you stop feeling fear or boredom. It means you possess the discipline to follow your structural workflow, even when every instinct in your body is screaming at you to deviate. Even with a checklist, there is one final psychological hurdle that destroys accounts from the inside out: the human ego, and its absolute obsession with being right on every single trade. Our egos are deeply wired to treat a financial loss as a personal insult, but the markets operate entirely on probability. Even the most thoroughly researched, statistically sound setups will inevitably fail a certain percentage of the time. Professional traders neutralize their ego with strict boundaries before money hits the table. Notice the red "trade idea invalid" zone on this USD/USD chart. If price enters that territory, the ego is silenced and the system automatically cuts the position. A basketball player doesn't walk off the court forever just because they miss a free throw. In trading, a triggered stop loss doesn't mean you are a failure or that your strategy is broken. It simply means that specific probability didn't fall your way today. This requires a total mental reset regarding how you view taking a hit. An amateur looks at a red number on their screen and internalizes it as a disaster. A professional looks at that exact same red number and registers it as a standard business expense. Think about a shopkeeper running a grocery store. Every single month, they have to pay for inventory, electricity, and the lease on the building. They don't break down crying when the rent check is due, because those expenses are required to keep the doors open. In the business of trading, you do not have electricity bills or retail leases. A properly sized, heavily controlled stop-loss is simply the rent you pay to keep operating in the market. By leaving your ego at the door, treating minor losses as the cost of doing business, and rigorously following your pre-market checklist, you stop fighting the chaotic twists of the road. You finally become the master of the vehicle.